With Scott Miner. Just to remind you, Scott is the chief strategist with Guggenheim Partners, where he helps manage $75 billion in assets. Scott previously worked as a managing director at Morgan Stanley and at Credit Suisse, where he oversaw fixed income credit trading in the U.S., Europe, and Asia. So, Scott, tell us, what indicators are you looking to right now to determine where markets are headed?
Well, I'm keeping a close eye, obviously, on the foreign exchange markets. The recent bounce in the euro, again, shouldn't be a surprise. We got to support. The thing was deeply oversold. Once I see that turning down again, I think that will give us a warning sign for the equity markets. But one of the things that, Lori, most people are not focusing on very much, which I think is really probably the most important indicator, is Libor. The rate at which banks lend to each other keeps creeping up. And even with the recent rally in the euro and with the good news today in the stock market, Libor continues to rise. And what that's telling me is that at a fundamental level, banks are afraid of lending to each other, and there is a real concern about the viability of the financial system and how much credit exposure is in the banking system in relationship to sovereign credits.
And Scott, this climb in Libor, does that give you pause for concern, at least about the quality of banks' collateral?
I mean, can we see another credit crisis?
Yeah, exactly.
Well, it's interesting. Everybody is so focused on the quality of the credits on the balance sheet, and certainly I have a lot of concern about the quality of sovereign credits around the world at this point. But the thing I think people are missing in this story is it isn't that we have to have a very bad situation in credit. We just have to have people concerned about it. And given the level of concern there is in the market right now, we're seeing literally all the liquidity recede, which came into the market as a result of the recent recovery. And if that continues, that in and of itself can cascade into a financial problem.
But isn't it good for the U.S. economy, specifically mortgage rates, that interest rates are down? I mean, the 10-year yield looked like it was going to flirt with a 4% level yesterday.
Well, you mean the 3% level?
Thanks, yes.
I agree with you. And I think that as the euro continues to appreciate, interest rates in the United States are going to fall. I personally don't see any reason why 10-year rates can't get below 3% on a sustained basis for a while. And that's going to be very good for the housing market and the mortgage market. The flip side of this, though, is that as the euro continues to appreciate, it's going to make U.S. exports less and less attractive. And exports have actually been a significant contributor to U.S. growth, and it's going to put more deflationary pressure into the system, which will keep interest rates low, but will make us less competitive as an economy throughout the world.
Scott, can I get your thoughts on what's been going on in the markets, specifically volatility, because we were talking to our Adam Johnson and Dominic Chu about what's going on with the VIX index. You believe that volatility is your friend. Why?
Well, every time volatility spikes in this way, it's an opportunity for people to essentially sell volatility and collect the premium. And the way for most people to get there that would be listening to this show today would be to be selling options on stocks, or whether they sell puts or they sell calls.
Right.
And if you look at it over the long term, when you get volatility to these kinds of levels and it returns to normal, it's a great investment, and we think volatility as an asset class should be in every portfolio.
Just a couple of seconds left. Could you give us an example of how to take advantage of volatility through options, like say on S&Ps?
Sure. Well, one thing to do quickly would be to basically buy the S&P 500 and sell a call against it. That would be, and you can do that with the spider, and just collect the volatility over time, because as volatility recedes, which I think we'll get as we continue to rally, you should be able to make money out of it.
All right. Appreciate your time and your insight. Scott Miner is the chief strategist at Guggenheim Partners.